All right, let's jump right into this. Today, we're popping the hood on the single most massive financial shift in modern tech history. We're talking about a completely unprecedented redirection of global capital, driven by just a handful of corporate giants, and it's fundamentally rewriting the rules of both technology and economics as we know them. Welcome to The Explainer.
Here's our roadmap for today. We'll start with the trillion-dollar AI gamble, take a look inside the financial machine, and unpack why it's all about market share over profit right now. Then we'll cover dominating the cloud, the hidden power of monopsony, and wrap up with the next growth horizon.
So Section 1, the trillion-dollar AI gamble.
We are witnessing an infrastructure build-out right now on a scale that is just literally unheard of. The price tag? A staggering $1.1 trillion. That's the combined investment into AI infrastructure from Google, Amazon, Microsoft, and Meta just since 2023. To put that into perspective, that's roughly the entire GDP of the Netherlands, just being poured into a single technological bet. And they aren't slowing down. They're expected to drop another $745 billion into this space this year alone.
What's wild here is the historic pivot we're watching happen in real time. Big tech used to be all about software and code, that highly profitable capital-light model. Not anymore. Today, they are massive builders of heavy physical infrastructure. They're signing off on billions in long-term commitments for land, cooling systems, servers, and power grids. They've essentially transformed into heavy industry titans overnight.
Now, as you can probably guess, this spending spree is absolutely obliterating their cash reserves. The combined free cash flow for these four giants recently plummeted to a decade low of just $7 billion. I mean, think about that. Google actually reported its first negative free cash flow in over 2 decades, hitting negative $6 billion. The financial shock to the system is very real. It's even causing ripple effects across the market, like when Apple shares took a 6.3% hit simply because the sheer demand for AI infrastructure is driving up the cost of basic tech components. Yet, despite all this strain, they just keep pushing the gas pedal.
Which brings us to Section 2, inside the financial machine.
So how on earth did these companies avoid going bankrupt while burning cash at this kind of historical rate? Well, they've had to entirely rewire their internal financial operations. Forget traditional quarterly reviews and static Excel sheets. Their finance teams are now operating on a relentless weekly rhythm. They're actually using AIs themselves to run thousands of multi-scenario simulations simultaneously. They map out the sensitivity of variables, exchange rates, competitor moves, supply chain bottlenecks, and this allows them to greenlight billion-dollar hardware investments almost instantly. They're moving with the agility of a startup, but wielding the capital of a nation-state.
But here's the real kicker. They literally do not care about immediate profit margins right now. When a billion-dollar investment is on the table, the question isn't how much profit will this generate next month. The only question that matters is how will this shift market share. They are locked in a brutal winner-takes-all war. Gaining a 1% market share today is vastly more valuable to them than improving profit margins by 2% tomorrow. Every single dollar is weaponized to capture long-term dominance.
Let's look closer at that in Section 3, market share over profit.
You'd think investors would be punishing them for this kind of reckless cash burn, right? Actually, it's the exact opposite. Look at the absolute dominance of the Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. By the end of 2023, these 7 behemoths grew to represent more than a quarter of the entire S&P 500's market capitalization. They account for 28% of its projected free cash flow. They aren't just a part of the market anymore. They essentially are the market.
And there's a really fascinating divergence happening here. For the other 493 companies in the S&P 500, stock prices largely went up due to multiple expansion, meaning their valuations inflated without them necessarily making more money. But the Magnificent Seven? Their surging stock prices were driven by actual concrete earnings. Their projected earnings and free cash flow growth are roughly double that of the rest of the index. They are actually backing up those sky-high valuations with real revenue.
All right, Section 4, dominating the cloud.
So where exactly are those massive concrete earnings coming from? Mostly, it's coming from one specific hyper-competitive battlefield, the enterprise cloud. Together, just 3 companies, Amazon, Microsoft, and Google, control 63% of the entire $107 billion quarterly cloud infrastructure market. They are taking all that massive compute power they're building and successfully renting it out to everyone else, from traditional legacy corporations to top-tier AI startups like OpenAI and Anthropic.
Now, you might hear some buzz about smaller neoclouds like CoreWeave, Crusoe, and Nebius.
And yeah, they are growing rapidly, trying to carve out little AI niches for themselves. Oracle is slowly inching its way up too. But let's be real, the gulf between the big three and everyone else is only getting wider. Just to give you an idea of the scale, third-place Google is still nearly 4 times larger than the fourth-place contender Alibaba. The giants are just playing an entirely different game.
Which leads us to a massive, under-discussed systemic risk in Section 5, the power of monopsony.
We're all familiar with monopolies, where there's only one seller, right? But big tech's current position is creating a monopsony, because they are the ultimate sole buyers of critical AI resources at this insane scale, advanced chips, components, energy contracts. They possess the sheer gravitational pull to totally dictate terms. They can ruthlessly squeeze their suppliers to keep their own costs down.
But here's the catch, and it's a big one. This unchecked monopsony power is a total house of cards. You can't squeeze a vendor infinitely. Eventually, suppliers balk, or they just go under completely. If big tech pushes these suppliers too hard on price, the very hardware and energy infrastructure that they desperately need to fuel their AI ambitions could collapse right out from under them. It is a highly delicate, high-wire act they are walking right now.
Finally, Section 6, the next growth horizon.
Despite all that supply chain risk, the staggering cash burn, the brutal competition, the consensus is pretty much universal at this point. We are standing on the edge of a massive, secular shift in technology. Think about the progression. We had the advent of the internet in the 90s, the mobile computing explosion in the 2010s, and now the 2020s generative AI transformation. Integrating this tech into healthcare, finance, mobility, manufacturing, it's expected to be just as fundamentally transformative to society as the birth of the internet itself.
Big tech has decided to shoulder the massive financial burden to lay down this $1.1 trillion physical foundation. But the true world-changing value of the next decade really hinges on one simple yet incredibly profound question. The infrastructure is being built. It's here. So, which emerging companies and in which industries are going to step up and actually use it to change the world?